Welcome to the Coverage and Coffee podcast. My name is Caspar Harsey. Joining me today is
Harsh Chandani.
welcome back, Harsh.
Thank you.
Yeah, you've been out for a little while. Not as long as Mo's been out, but yeah. What do you think of the interviews we did before we dive into today's topic?
The ones with Razak and Kit.
And Apramea.
And Apramea, yeah.
It's been a while.
It has been a while. I think they've been pretty fun to explore because, we have some people from the industry, so we are getting kind of real world knowledge right now.
Yeah, I mean, it's actually I found it incredibly difficult actually, kind of taking a step back, being meta here because we're on a podcast about insurance, but like we obviously do research about these podcasts. We don't just come on here and yap about what we've heard about. And I keep telling people that there's so much more than meets the eye when it comes to insurance, but actually finding that information somewhere is quite difficult. I think primarily because when the companies that have an incentive to share something about insurance have an incentive to share it a certain way, right? There's so much advisory within risk. So you start going online, you start searching something like political risk insurance, right? When we were talking to Kit, and we get this, we get the boilerplate, a company trying to sell their political risk insurance. And then we get the websites that regurgitate information that mostly got their information from these websites. So you end up with the kind of, I guess, the towing the line kind of perspective.
Yeah.
But then it's always really good to have people who've been in the industry and been on the podcast. Obviously, we talk to a lot of people within the industry all the time, but being able to have them on and hear it straight from the horse's mouth, I guess.
Yeah. I feel like since they're still a part of the industry, it's we kind of gain a better perspective about things that are going on currently. So it's not outdated information.
Yeah, I mean, it's also information from different years of experience, right? Looking at Apramea, looking at Razak and Kit, right? How long they've been in the industry, because I think this is something we talk about a lot actually on this podcast. And ironically enough, we are going to be talking about a couple historical events today. This is kind of one of the episodes leading into Christmas. It's a little bit more quiet. We have more guests coming in the new year, but we're kind of going to do a little bit of a exploration today on different subjects. Some of the things may have some overlap with some of the things that we spoke about with some of our guests, right? When we're talking about political risk insurance, when we're talking about where, how do you actually look at risk and how do these things kind of change, right?
Yeah.
So today we're going to be talking about 4 major moments in the last, I guess it's 25 years that we're kind of focusing on specifically. One of them we've talked about quite a bit, or it's come up quite a bit. We're talking about the pandemic once again. Slightly different lens here that we're going to be talking about. We're going to talk about the .com bubble.
Yep.
So those who don't know what the .com bubble is, it's a really interesting topic to explore right now when you're making parallels to AI. But the .com bubble is actually how, do you know Mark Cuban?
Yeah.
He got rich from the .com bubble. There was a couple of people who managed to sell at the right time before the bubble really popped.
Okay.
But the .com bubble was kind of this first wave of technical internet-based innovation. And the problem is it was probably a little bit ahead of the curve in terms of what people were trying to sell and what they were promising, but also just in terms of general usability, right? Not everyone had a computer in their house in the early 2000s, right? Now that's not the case, right? Everyone has a laptop, everyone has a computer in their phone. The other scenario, which is also, it's ironic how close these things kind of occurred, but Y2K.
Yeah.
Had you heard about Y2K before I told you we were talking about Y2K?
No, I was born 4 years after it happened.
Yeah, I don't say that again. I mean, I was only born 2 years prior to it happening, so it's not like I was boots on the ground trying to sort out Y2K. But I remember, I watched a lot of Simpsons growing up, and they would make like cultural references all the time, and they would talk about Y2K, and I, as a little kid, was like, "What's Y2K?" Right? And it's in summary, it is the. I'm not going to get into the technicalities of it because I do kind of understand it, but I didn't explore it in that lens. It's the fact that when computers were coded and when data systems were coded and infrastructure for technical solutions was coded, it wasn't necessarily coded to roll over from 1999 to 2000. So the fear was that systems were going to break, right? Like airline systems were going to break. The computer inside the motor of the airplane was going to malfunction on Y2K, and it's all going to fall apart.
Yeah.
And then as early pre 2000s news cycles go, it kind of became this thing that the aliens are going to take over. It's sometimes a bit you'll see in some TV shows. There'll be like some doomsday prepper preparing for Y2K, right?
Preparing for Y2K.
And then the last topic that we're going to explore is 9/11, which is a incredibly sad event that occurred in 2001. They say never forget, but I gave everything else a little brief intro. I'll give 9/11 a brief little intro. But it was a terrorist event that occurred in New York City, where 2 planes hit the Twin Towers, and there were a lot of insurance-related changes that occurred off the back of this, actually. Before we kind of dive in, I'm not sure I'm going to dive in necessarily that order. I might do Y2K, 9/11, dot-com bubble, and then the pandemic, because that's chronological. Before we dive in, do you have any initial thoughts, questions, or things that you're kind of curious to explore as we get to that topic?
I think we'll just take it topic wise. So once you talk about an event and any questions arise to the top of my head, I'll just ask them as we go.
Yeah, sounds good. Sounds good. So like I said, we'll start with Y2K, which was this kind of rollover into the new millennium, situation, right? And it's funny, I didn't actually know this. I'm starting off completely unrelated. But have you heard in the news recently, like the US admin talking about like a borders czar?
No.
Well, they'll refer to some guy was put in a position, and his role is the border czar, right? And like CZHR, and it's like the person in charge. It's a kind of interesting that they're using that term. I thought that was a recent thing, but it turns out that back in Y2K, so the year 2000, Bill Clinton. Oh God, I who was president in 2000? Who was president in 2000? Yeah, Bill Clinton. There we go. Bill Clinton had a Y2K czar who actually spent the New Year's in a plane to prove that they were safe, because there was a lot of skepticism. There was a lot of fear actually in people that, they go to the bank and their bank's not going to remember how much money they had because all their computers wiped and things like that. So an estimated $300 to $600 billion was spent leading up to remediate the situation, right? Because it wasn't completely false, right? There was, people are talking now about vibe coding and, but back then you had less resources and you were kind of just coding things that worked. And sometimes that involved with counting out the individual years, not having like a calendar index or a function that actually understood dates, but you had every single date pre-mapped. So maybe it wasn't mapped past 2000. So I have a feeling that 300, 600 billion, was probably spent also just optimizing things, not just like, oh, we got to prep for Y2K, but like exploring things, auditing things, and then coming up with the right solution, and then maybe making some optimizations along the way.
Yeah.
150 billion of that was spent in the US alone. I would have assumed that would have been more, but I don't know what the technological market looked like in the year 2000. I guess there is more countries outside the US than the US exists. So the initial estimates of this was that there was going to be approximately $35 billion in claims, right? So this is things breaking, this is service contracts falling apart. Can you take a guess on how many claims actually came?
10.
$0 worth of claims actually came from this.
Okay.
And I'm about to say the catchphrase. Guess what? It came down to wording. So what's really interesting about insurance is that insurance doesn't cover the risk of doing business, right? So let's say the example I like to use to explain this is like, let's say I start a business, right? And my business is gambling. I'm going to go to casinos. I'm going to put it on red every single day. And then sometimes it hits red and sometimes it doesn't hit red. And then I end up losing money, right? The money it costs to do your business is not insurable. This is the risk of doing business.
Yeah.
Insurance is there to take the other risks away from the plate, right? Things that are not related to your business, right? If I am in the casino and, a mobster whacks my leg, they might insure that. That's not a part of the business. Or I guess maybe it is.
Depends on your wording.
Yeah.
Yeah.
So in this case, they said that Y2K was something that they knew was going to happen, right? We knew it was coming into this situation. Some big companies actually tried to claim. I think I read. Let me actually quickly look into this. I think I read that Nike even tried to. Let me see. What do I have here? In Nike, Stanford University, GTE. I don't know this company. It's a telecom company owned by Bell. I guess it's now Verizon. So the old Verizon tried to take claims on this because that makes sense. I think that old infrastructure kind of makes sense.
Yeah. I guess that prompts me to ask that, would Y2K be insurable today? And if it would be insurable, what kind of policies can be taken out on this? Because I don't understand what people would be claiming on. Like you mentioned, no one claimed on it.
No, people claimed on it.
Okay. The payouts were zero.
Yeah, GTE, Verizon, Stanford University, Xerox, they all seemingly claimed on it, but they were all dismissed by the courts.
Okay.
Y2K, the courts said specifically this, that Y2K problems were inherently vice. So that kind of means that they were rather a well-known risk of business. It's a known risk of business, right? You're not going to know on the 13th of August that your bakery will get hit by a car, right? Because if you did know, then you were probably in on it and it's, fraud.
Yeah.
But like if you're not, let's say you don't do anything leading up to Y2K and then Y2K occurs, you had sufficient, you have a burden of responsibility to protect yourself and protect your business, right? If Y2K was the kind of thing that nobody realized was going to happen, right? Not a single person in the tech space was like, hey, some of these numbers don't go past 1999, 31st December. No one said anything. And then it happened. And then damages occurred. That would have been an insurable risk, I'm sure, depending on the policy that you had, right? But it's really it's a really interesting situation because I guess your question, like, would this be covered today? I mean, if the same thing kind of happened for whatever reason, we can't go past 2030, right?
Yeah.
And we all know we can't go past 2030, and now we have X amount of years to fix going past 2030. It still wouldn't be covered, right? Because it's a well-described risk.
Yeah.
I'm trying to think of something similar, right? Because the fear was that things would randomly shut off, right? And some of these systems back then were like perpetually on systems, right? The boot was a part, like the fact that everything built was a part of the bootloader, right? Now bootloaders, now we're getting technical, I'm sorry. Bootloaders are now separate from a lot of the operations that you're doing on your computer, right? The code or the infrastructure on your Mac to start your Mac is separate from running Chrome on your Mac, right? Completely separate. Back then, there were a lot of monolithic systems, right? Everything was done at once. So if one thing didn't build correctly because the date input was 2000 and the max was 1999, then it wouldn't even start, right? I don't really think we're going to come into a modern Y2K. Like for some reason, the only thing I can think of is a solar flare, right? Like, so, the sun can sometimes send off these whiplashes of solar radiation and that would fry most electrical infrastructure that we know today, right? And then everything would be shut down. That's a very different kind of event.
Yeah I don't think that's very related to what Y2K did, like the bug. But yeah, I don't see it happening either.
Yeah, I mean,
and even if it did, I don't think it would be such a major problem that it would affect people's daily lives or like the running of operations of a business per se.
Yeah, I mean, I guess the closest equivalent that I can really think of is the Cloudflare outages we've been seeing so much, right? But that's not even covered by insurance necessarily. It can be depending on the source. Like Cloudflare might have a data center provider who had a fire And then yes, indirectly it's covered. That's typically covered by something called SLAs, right? Like service level agreements, right? Well, what percentage of uptime do you expect when you sign a contract with someone? And if we breach that, then yes, we will pay you back the damages that you do. I'm actually not sure if SLAs are insurable. That could be interesting to explore.
Yeah.
But that's Y2K. Now, one thing that Y2K kind of changed within the culture was that prior to this, a lot of things were saved on paper, right?
Mhm.
People would print things out. They had paper reports. They would file them in the file cabinet. It led to a lot of off-premises data storage, right, or record keeping came
Mhm.
if you've ever worked in a corporate place, you might see the company Iron Mountain. I assume they probably got pretty big during Y2K. You know what? Actually, I'm going to see if there's anything around that. So Iron Mountain, really cool name, by the way.
Yeah.
But it's like an offsite storage thing. They come pick up some boxes, they'll file them for you, and then you can make a request to get something sent back to you. So you also got to keep track of where everything is. Iron Mountain Y2K. Yeah, Iron Mountain was a major player in the Y2K era. Doesn't really say how much really happened, but they were really important in safekeeping information and stuff. It became the leading software escrow company in 1997, leading into Y2K. Actually, damn, connecting those dots in here.
Mm-hmm.
This is interesting. For what reason?
What are you talking about? Iron Man?
Or this off-premises?
Oh,
Any guesses?
Okay, I'm gonna go the negative side here and say that it just allowed companies to hide information from authorities.
Interesting.
Yeah.
Interesting. I will reveal the answer in just a second because it's related to the next topic that we're discovering, which is 9/11.
9/11. Is it tax related? Are we going the tax route?
We're getting closer. But yeah, 9/11. Rest in peace to the 2,796 people who died. This will be less about the politics. This is not going to be us joking about whether Bush knew anything about this.
Yeah.
We're going to be talking about this from an insurance perspective because it actually not only was the whole situation incredibly interesting or unique, obviously, but it also led to a lot of fundamental changes on how insurance is handled.
Mhm.
Because this is not the only terrorist activity that actually happened on U.S. soil. So we had the 1993 World Trade Center bombing, which had $510 million worth of damages. So that, I think, was a truck bomb in the basement of the World Trade Center. And then we had the Oklahoma City, I think it was the City Hall bombing, which was $125 million worth of damage. Now, when we're talking about the specific damages from 9/11, we're talking insured losses right now because obviously there were huge cultural differences, but there were $40 billion worth of insured losses from 9/11. At the time, the largest insurance event ever. So in that context, it makes sense that a lot of things changed.
Yeah. I mean, to think that terrorism risk insurance wasn't even a thing before 9/11 is
so that's probably the main change here. Actually, it led to in the U.S. and in many other countries have similar kind of policies at this point, but it led to the TRIA, the Terrorism Risk Insurance Act. Prior to 9/11, terrorism was just a part of your property insurance, right? Like it was included. It wasn't even like itemized as separate. It was just one of the events that could trigger your property insurance.
okay.
But in this act, this came in 2002. It took a year, right? The U.S. was very quick to make a lot of different acts following the 9/11 attacks.
Yeah.
The government will pay 80% of insured losses above insured deductibles with a $100 billion program cap. So this is a huge amount of money that is now set aside to help insure. So the insurers will still pay you out.
Mm-hmm.
But they then get that money paid back from the U.S. government. It is currently extended till 2027, and so far it hasn't actually been triggered a single time, right? Knock on wood, thank God, type thing. But it was an incredibly interesting. So the fact that it was even included from the get-go Warren Buffett, who you know, he owns Berkshire Hathaway.
Mm-hmm.
They're actually really, really big in insurance. I don't know if you know that. He makes a lot of money from insurance.
Okay.
A
I didn't know that actually.
Yeah, one of the fun facts about Berkshire Hathaway is that they don't reinsure. So I don't know if we've actually talked much about reinsurance. I'll give a quick recap, but
Yeah.
insurance companies and underwriters, they have their own portfolio of assets, right? So when they sell you insurance, there's the concept of risk transfer. They are transferring your risk to them onto their portfolio, right? So they'll have a certain amount of money to pay out things, a certain amount of money represented in this transferred risk. They can then take their portfolio and get reinsurance. So there are insurance companies that provide insurance to insurance companies. They're called reinsurers.
Yeah.
And Warren Buffett doesn't actually get any reinsurance because he believes that it's better to have a very stringent and direct actuarial underwriting model the first time around. Rather than take big risks and then get reinsurance to cut our profit margins, we will take less risks, provide very solid and stable insurance, and then we don't have to spend a huge amount of our money getting insurance for our insurance. Anywho, side point. He was he critiqued the industry for not recognizing that there should have been some sort of terrorism difference, right? He actually called it foolish and a huge mistake. And it really, a lot of people kind of echoed these ideas because these actuaries are supposed to look at all these kinds of risks, right? And when we're talking about other things, .com bubble, pandemic, when we're talking about the Ukraine-Russia war, any of these different topics,
Mm-hmm.
there's a lot of times where the insurance industry, I feel, kind of hits itself in the face and they're like, well, oops. And then everyone's like, well, this is supposed to be the industry of risk. Why did we not figure out this risk?
Yeah.
Yeah.
Yeah. I mean, do you want to talk about the blow that the insurance industry took, amounting in losses? Like the payouts that they made, they were approximately $40 billion
Yeah, no,
during 9/11. Yeah.
I think I mentioned that before.
Yeah.
How it's specifically made up is actually the largest portion here is business interruption,
Mm.
right? The whole country stood to a halt, right?
Yeah.
Let's say, and it's not just things. These are not just claims related to the towers falling. This is the fact that planes were down and packages, things that could have perishable goods in them, right?
Yeah.
They got destroyed. There were, huge, ripple effects from this, right? Property damage, obviously, very, very huge. I think the buildings themselves were 4 to 7 billion in valuation, somewhere between there, right? Property values have increased a lot. I wonder how much, this would be worth much, much more nowadays. But
Were both towers separate policies?
so this is actually really quite interesting. Larry Silverstein, I don't know who he is actually. I was supposed to search that before, but I forgot. Larry Silverstein. He is an American businessman. He rebuilt the World Trade Center, but he had a 99-year lease on the World Trade Center that he signed 7 weeks before the attack. Don't do that. And he had an insurance policy that covered $3.55 billion per occurrence. But I've actually heard anecdotes about this, right? I've actually heard this when I've been to Lloyd's. I've heard this from a lot of people. The policies weren't fully finalized and signed. And there were a lot of overlapping policies during this situation. And initially, I think they only considered it one event. You'll get 3.5 billion, right? But he argued it was 2 planes hitting 2 different buildings, so it should be 2 occurrences, so 7.1 billion. And there came a little bit of a lawsuit from this. I don't know exactly how long this took. I think it was actually settled pretty quickly because if I'm not mistaken, Lloyd's of London kind of stepped in, right? Because this is a huge policy. So a lot of this was done in the wholesale market. And they kind of stepped in and they said, if we fight the 9/11 claim, this is not good marketing for the insurance companies if they win. Yes, they save a couple $1 billion, but we're talking about $1 trillion industry.
Yeah.
And the final settlement landed on 4.55 billion. And it was a multi-insurer event, right? A lot of wholesale policies, a lot of these big ones have multiple insurers, and it was uncertain who was following who had very clear language. And it was one of these events, once again, where the reason why everyone nowadays is saying your wording is so important, these are lessons that were learned through hardship, right? Wording is important, is something that I've said, and I think I've said this in a podcast before, it's set on precedent, right? Not president, but precedent, right? Like, what was the last time this wording was used, right? And at this point, a lot of wordings have been kind of fleshed out and they've been used, and we understand how they play out in court. And that's how we exactly know, like, okay, when you get this wording, this is what it means in terms of coverage. So you really have to watch your wording. But it's a really fascinating situation from an insurance lens, right? Because so much changed from this, right? Not only the kind of understanding within the risk insurance industry about where they play in terms of, are we really the smartest people when it comes to risk? There's so many shortcomings, the wordings, and obviously governments have been involved in insurance for a long, long time, but this is one of the biggest direct implementations from insurance until one of the next examples that we're talking about. Any final thoughts here?
Yeah, no, I don't have any final thoughts. I
did ask you a question before we started this topic.
Oh, the tax related.
No, the having things off premises.
Mm-hmm.
So it's not tax.
Okay, yeah.
It is said that the cultural and practices brought in from Y2K of having off-premises storage saved pretty much the world from total economic collapse following 9/11. Because we're talking about the World Trade Center, the financial hub of the United States, and therefore a lot of the world, especially at the time. Obviously, it's still the case. The US is a huge hub for financial activity, but it was a huge aspect within why everything wasn't completely lost, right? Because we're talking 2001. People had papers, they had faxes, they were storing things in their office, in their desk cubbies, right?
Yeah.
Obviously, there was like data communication, there was these kinds of things, but like not everything was backed up. We didn't have the cloud, right? But because so much of this was stored off-site, there was still a huge capability of things being tracked and traced in this case. Kind of crazy.
Yeah, it is.
Kind of crazy. So that's how Y2K connects to it did actually stop a financial collapse. Now, I think that people, going back to Y2K, I think people were a little crazy on the exact damage it was going to do. But the things that Y2K implemented probably stopped damages way larger than people expected from Y2K.
Yeah.
Right? Like rational people expected from Y2K. Yeah, kind of interesting, huh?
Yeah, I went completely down a whole different path there.
No.
Yeah.
I mean, it makes sense. It was a very open-ended question. Don't get me wrong.
Yeah.
And that is going to lead us to our next topic, which is the .com bubble. Now, when .com bubble, it is a little bit interesting that we said the last 25 years, because these three events all pretty much happened from 1999 to 2001, really. The .com bubble, actually, I just said that we were going to do things chronologically, but it kind of seems like it may actually have popped before 9/11 had had happened.
Yeah.
So I guess I got the chronological order wrong here. But yeah, the .com bubble, like I said before, for those who don't know, I'm not going to go into it like very, very deep here, but it was kind of a mismatch between what people thought they could do with the internet and what people thought they could do with computers at the time. There's a lot of ideas. If you look at some of the biggest .com companies back then, and you look at some of the big companies today, and you're like, how did none of those .com companies become the biggest companies today? It's because that it was, and it's so funny because we're in this AI bubble right now.
Yeah.
We're talking about these parallels in terms of companies promising things they may not necessarily be able to do. We're talking about this kind of investment into these ideas. Anywho, the biggest part of insurance related to the .com bubble has to do with directors and officers insurance, right? also a little bit into professional liability insurance. So professional liability, I'm not sure we've talked about that so much. I think I
No.
have actually, about architects. If like an engineering architect makes a mistake on a schematic, right? Yes, the construction company built it, but they followed a schematic, and then the professional liability insurance of the engineering firm will then pay out. So
Okay.
that's that situation. In the dot-com bubble, it was D&O insurance and it was professional liability insurance that were the real big things that happened here. And
Yeah.
this was interesting because it was on both the investors, like the companies themselves. The few dot-com companies actually got D&O insurance. There was those guys, right? They were saying things and they were, maybe selling things that they couldn't quite deliver on. There was the actual investment banks and investors themselves who had huge D&O stuff because they were investing things they didn't fully understand, and you're being hired to do a certain role and do a certain thing. You're supposed to understand what you're doing. And then there was the auditors themselves, actually, because the auditors didn't understand it either, right? They're gonna, an investment company will be like, oh, we're gonna invest 100 million into, let me just find a random .com bubble company name.
Wait, so what actually caused this market collapse in the during the time of the dot-com bubble?
What? Yeah, let's look at it. What caused the .com bubble first? Yeah, it was mostly just incredible overvaluation of these companies, paired with a increase of interest rates. And when these investors, because I think a lot of these companies were publicly listed, or they were the first wave of SPACs. Let me look into this. Yeah, so these were publicly listed firms. They would very quickly go to before they had even really finished their product or really gone into market, they would go on to NASDAQ. They would go on to the stock exchange.
Yeah.
And then people were investing, hand over foot to get a slice of this growing industry. And then the interest rates got risen by the Federal Reserve. I don't think it was to target these guys specifically, but monetary policy is monetary policy. It needs to do what's best for the economy.
Yeah.
And that led to a lot of investor speculation, which led them to sell off their stocks incredibly rapidly. And back then it was a very small network. So, you realize other people are selling, oh my God, like I bought at 1,000. If people are starting to sell at 1,300 because of interest rates, I should sell before I hit under 1,000 because I don't want to lose any of my money.
Yeah.
And then that creates a ripple effect where everyone just starts selling off their stocks because there was no underlying asset behind them. We didn't know how to properly value these tech companies at the time.
Yeah.
But yeah, it led to huge amounts of investor losses, right? Like I guess, these aren't quite. Some of these examples that I found aren't quite, but WorldCom, for example, let's see what WorldCom was up to. WorldCom, it was a telecommunication company. Well, this fell due to accounting fraud, but you also have to think that a lot of these companies, like there were scandals that kind of stacked on top of each other, right? If you were an investment firm who were investing into some of these .com companies, and then all of a sudden you're seeing losses, maybe you don't want to report those losses, and you're going to hide these things. Now we're getting into the direction that you were going, tax fraud, hiding money. But it was really, really interesting. After the .com, so pretty much 2001, 2002, D&O insurance went double or triple its increase in premium. Right, because all of a sudden shareholders were suing the executives of these companies for falling short in their responsibilities. And this hard market lasted quite a while. It settled down a little bit, right? I'm sure it picked back up again after 2008. Then it kind of settles down again.
Yeah.
And insurance does go through these cycles of hard markets, soft markets. We have talked about in the past. But what's really interesting is, like I said, the parallels to AI right, that we see today, right? You can see all these graphics. I'm sure producer Harsh here or host Harsh here will throw it up on screen. Let's take a look here. You've seen the big NVIDIA circle, right, with the investments, and then all these companies are investing inside of each other. It does kind of shout bubble a little bit, and I don't think that people fully understand their valuation, right?
Yeah,
we're starting to get these AI related class action lawsuits, actually, right? Like you screwed up my work, or I put up an AI investment bot and I lost all my money, right?
Hmm.
I saw a YouTube video once about this guy who hooked up his fish to invest in the stock market. And when his fish swam somewhere, it would buy a random stock in this wheel that he put around the fish tank.
Okay.
And then recently, I saw a video of someone giving AI free reign to invest. They got $10,000. They lost $10,000 in 7 days. The fish made like $100 after a month.
Hmm.
So it was completely random,
Yeah.
right?
Yeah.
But very interesting in this case. And we actually see, so Berkeley, one of the larger insurance companies in the US, actually has an AI related loss exclusion from their D&O policy, right? So
Okay. So
if you went and you marketed this big AI thing, people start investing in you, it turns out it's all nothing,
mhm.
they sue you, your D&O policy will not come in and protect you, right? D&O is supposed to protect the shareholders from being, or the executives of a company from being sued
Yeah.
by their shareholders 90% of the time.
Yeah, but no, this does make sense though. You're just kind of holding them accountable
Yeah, but that actually goes
to.
against the corporate veil. This is a really big part of American capitalism, is the corporate veil, in the sense that the executives of a company are not necessarily responsible. So the whole point of D&O is to kind of, hush money these types of
Mhm.
lawyer situations. But it's incredibly interesting because it really has to do with, like, do you believe that these executives acted like they did not tell you what they were going to do, right? Because it's one thing to say, let's say I go to a bunch of investors this year and I say, hey, we're building this AI thing. And then they say a year from now, and then they give me money. And then I tell them everything and it goes poorly. We lost all their money. We're going to close up shop. They can't sue me.
Yeah.
But let's say I didn't tell them that, and I'm like, hey, we're gonna, we're doing all this, and then it's going terribly behind the scenes, and nothing's going on, right? And I'm lying to, like, hand over foot every time they ask me about it, and then everything blows up. Then they can sue me for it because I did not act in their best interest. I did not actually perform the duties of my job.
Yeah, so how do, I guess my question is, how do you then kind of understand whether they were acting like this all throughout?
Well, that's the discovery period of the lawsuit.
Mm,
I think that's a little bit out of my expertise at this point, but I
yeah.
don't think we've had any. I'm trying to, in my research, I don't think I found any AI related D&O claims. Let's see here. I mean, I can see a lot of stuff talking about using AI on D&O risks. That's interesting. So it does seem like there's a new type of D&O claim called AI washing, where companies exaggerate their AI capabilities or impact of AI on their business. Oh, what was that? There was a. Did you hear about Builder AI?
I feel like I've seen an ad on it somewhere.
Probably not recently, because they have gone completely. Yeah, they were once valued at $1.5 billion. Now,
Okay.
this is a startup. I don't know if this startup had D&O insurance. And startups are typically quite late at getting insurance, especially D&O insurance.
Yeah.
Sometimes you'll see investment terms that are like, you must get certain types of insurance for us to be able to invest in you, because we don't want to lose all your money because you're an idiot. Microsoft invested in this. I want to say either OpenAI or NVIDIA invested in this, but it was kind of this like, oh, what's it called? Like Cursor. It wasn't an IDE, but it was like this platform to AI build things,
Okay.
right? And it turns out that most of their development work was not a really good AI model or AI utilization model that was really good at using AI to code things.
Mhm.
It was 700 people in India developing stuff every time things came in through the pipeline. So it was probably a combination. It
That
was
is crazy.
700 Indian guys with AI developing, because at this time, because like Builder AI, when did this collapse? I want to say like a year ago. A lot of these articles are from this year, but maybe it was this year. Time is moving so crazy. I guess it was
Yeah.
only 6 months ago. But I mean, they got their investment. When did Builder AI get? 2023. Yeah, between 2018 and 2023. So they were quite early, right? So like they were quite early. AI wasn't that good at coding even just a year ago, right? Or maybe a year and a half ago. It could do stuff, but it wasn't the same it was today. So they were really marketing themselves as ahead of the curve on this, but they were just hiring engineers to fill the gaps that AI couldn't fill. I think if they'd kept up their ruse another year or two, they probably would have gotten away with it. Just slowly start replacing these developers with AI for some of the tasks and keep some of them for the more complex tasks. But it was obviously fraud. It's interesting to think whether did Builder AI. Sorry, we're doing a lot of searching today, but there's a lot of nuance in the topics we're talking about today. Did Builder AI have D&O insurance? They did. Their case study was the one that built this AI washing terminology. Doesn't seem like there's anything talking about any payout or anything. That's really interesting. These guys weren't cheap. They were charging like $25,000. I mean, to be honest, anyone from the outside. I actually there was another problem with these guys. I remember it wasn't just the fact that there were all these people, because they were still doing what they were saying they were doing. But they had this balance sheet glitch with this, like, I think it was a marketing company or something. The marketing company would invoice Builder AI for $1 million. And then Builder AI would invoice the marketing company for $1 million, saying that, we got marketing for $1 million. They got development for $1 million. But in reality, no work was done between them. And then they just kept doing this. The revenue was $50 million, but they had reported $220 million in 2024. So they were really greedy. They were juggling a lot of lies here. That's a little bit difficult to keep track of. Anywho, we're going to move on to our final topic, which is going to be short. It's going to be sweet. It's not going to be sweet. It's probably not going to be short. We'll try to be short because I think we are running kind of close on time here.
Yeah.
But COVID.
Let's do it.
Yeah, COVID. Yeah, we've talked about this so many times that I'm beating a dead horse here, but I really do want to bring it up because it has some connections to some of the other things we were talking about. The pandemic, when it first started between 2020 and 2022, generated over 2,300 business interruption lawsuits, right? Yeah. Because this made sense, right? And I actually know that there are terminology in some property policies. Oh, what's it called? It's not there's civil unrest, but there's some sort of government intervention, right? Like if your business gets stopped because the government has been like, you have a bakery on Main Street and the government's like, no one's allowed on Main Street because aliens or whatever. Technically you would be covered by things like that. But interestingly, most of these failed. Yeah. If all the US business interruption losses were covered, it would have cost $1 trillion a month to cover them. Because we're quite literally talking about, for a period of time, every single business was interrupted, right? And I keep saying a number, it's around $1 trillion. Insurance industry total size value. $8 trillion. I feel like I've been saying much lower numbers than that, like 1 trillion, 2 trillion.
But I think the claims would definitely be more than $1 trillion, because I think you're just talking about it from a US perspective.
Yeah. So yeah, exactly. This is US. This is $1 trillion per month in business interruption only. Yeah. The thing is that business interruption typically falls under your property policy. So the reason why these were not paid out, and I know we had a comment on this, insurance companies never want to pay out claims. I'm sorry, the stats do not actually support that. I understand you on an emotional level. I have felt that. But very often this is a differentiation between, I got property insurance, anything property related is covered. That's actually not the case. Like we say it with me now, read your wording.
Yes, sir.
But what actually ended up being constituted here was that the court said that the presence of a virus does not constitute physical damage. And because business interruption is based on physical losses, like someone drives into your bakery and the window is shattered, so you got to put boards over it and no one can enter or whatever, the virus does not have a physical presence, and it does not actually damage the property itself, which is what triggers the business interruption.
Yeah, and I feel like because of these claims being denied and whatever drove people crazy was policy wording versus the public's expectation on
Hmm.
this. Because, like you mentioned, the losses would be about 1 trillion monthly, and the industry can cover what it has about 8 trillion, right? The insurance industry would be completely wiped out if they had to pay out every single claim.
Mm.
And I don't know how much the government can even do about this, because sure, they were paying out the stimulus checks, but there's no more you can do.
Yeah, no, I mean it's actually quite interesting because a very different conclusion was found in the UK actually,
Okay.
and that was that this is not a full business interruption event because there were mandates, there were different things that you could do. Yes, people weren't coming out as much, but that has nothing to do with your property.
Mhm.
But it does constitute a partial closure. So the first initial ones were actually all said, this is not, we're not going to pay you out, right? There was a really, really big case between Orient Express Hotels and Generali, which is a South American insurance company. But they ended up, they went all the way up to the Supreme Court, who actually decided that no, this is actually covered. Partial closure, yes. And there were disease clauses in the US ones, right? Like, or in the UK ones. And this goes back to, like, let's say you, like, your establishment's got, insurance is a lot older here, but we're talking about like much older diseases that these disease controls were put into place on.
Mhm.
So they actually had to pay 2 billion, which is not actually that much, but that's because it's partial closure that I'm talking about here. The thing is that there were a lot of payouts that came out of this. So life insurance and benefits, health benefits, these kinds of things had huge payouts. $203 billion in payouts in the first year in the US, and life insurers with an extra $100 billion in death benefits being paid out, the largest increase since the Spanish flu, which was 100 years prior and very different, whatever. But there are parallels to what we were talking about before, which is the TRIA, the Terrorism Risk Insurance Act.
Mhm.
It brought in the Pandemic Risk Insurance Act. This was proposed, but it actually did not pass. Did not
Okay.
pass in the end. I think primarily because from what I'm reading here, they had some crazy ideas. What did I say about the TRA? That was up to 100 billion in damage.
I think so.
Yeah. When they tried to pass the PRA, it was $750 billion worth of damage. Which I don't think they would approve something that big.
Yeah, but I mean,
I think also because there were no losses, or the losses weren't the same.
I understand the amount, because it's
damages were huge.
Yeah.
Damages were huge.
Um,
Yeah.
but again, I guess government intervention was pretty critical during this period, right?
Oh, 100%. But it wasn't really insurance related, the government intervention.
Yeah.
Right.
Yeah.
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 Yeah. And those are the 4 topics that we're kind of diving into today. We may do another episode like this in the future, but where
Mhm.
we're gonna look way back. We're gonna look at like the very origins of insurance, things like that. I just kind of wanted to use these examples to kind of talk about how these large events. There's a book I really like called The Black Swan. I think I've talked about it before. I'm reading some of the author's other books right now. They're all about risk. And a lot of these big events, I think they give a lot of context to people, right? Because they remember the events, but they may not think about it from an insurance lens. And I mean, like that comment we got the other day, I don't think anyone has a good relationship with insurance. I don't think
Yeah.
anyone has a good relationship with insurance. But I think it's important to understand that these things are not necessarily done arbitrarily. Because I think what one of the problems that I have with the way that people treat insurance is that they amorphosize it into one giant blob, the insurance industry, right? But you should really look at the companies that you get insurance from. Sometimes it may be a good deal, but you can go online and you can see these guys don't pay out anything, right?
Yeah.
There are stats available for every single insurance company out there, how much they pay things out. And you would be surprised the difference between the payout rates. Yeah, do you remember the Luigi Mangione guy? I think it was United Healthcare.
Yeah.
They had a double denial rate from the rest of the industry in denying healthcare claims. And it really varies from company to company. And when we're talking about these examples, these are all different companies as well. We talk about the insurance industry denied claims for business interruption. We talk about there was a dispute on what was actually covered during 9/11. There were specific insurance companies related to this, and you can look at those specific insurance companies and you can see their policies and see how they act when it comes to certain types of risks. Look at your wording. Make sure you're working with a company that you actually aligns with your values.
Yeah. Also, really quick before we end this episode, so we were talking about COVID, right? And we've mentioned this multiple times before, but Wimbledon took out a policy on these events. What was the policy that they took out? What was the specific wording in it? Do you have any clue about it?
We've talked about this in podcasts before. I will give you a very quick summary. It was a events business interruption that had disease and pandemics as one of the triggerable events.
Okay.
So it wasn't like, I don't think that there's anything like specifically called pandemic insurance. There's events insurance. They had a reoccurring events insurance that included pandemics and disease as one of the reasons why the event may be canceled.
Okay.
But we've talked about this on different podcasts.
Yeah.
If we can figure out which one, I think we've talked about it on a couple. We might throw it on the screen now. But I am going to wrap us up here. We're getting a little bit long on this one. I wasn't really expecting. I thought this was going to be one of the shorter ones, but we really yapped a little bit. Thank you so much for listening today. We will have one more podcast this year after this one. And after that, we will be having a little bit of a hiatus until the start of the new year, where we'll kick it off with some new guests and some new topics as we look to explore insurance further.
Yep.
This has been Coverage and Coffee. My name is Kasper Harsey.
And I'm Harsh Chandani.
Thank you so much for joining us.
Thank you.